All right, today we're going to dive into the world of reverse mortgages. Because right now, as we're heading into 2026, something really fascinating is happening. The whole market is in the middle of a major shakeup. So let's get into it.
So, what is really going on here? On one hand, you've got certain companies just surging ahead, but on the other, the overall market is actually shrinking. It's a bit of a puzzle, right? Well, today we're going to put all the pieces together.
And here's how we'll do it. First, we'll see who's leading the pack. Then, we'll uncover this surprising market decline I mentioned. After that, we'll look at this squeeze happening behind the scenes, see how a new type of loan is stepping up, and finally, we'll talk about what this all means for homeowners.
Okay, first up, who's starting the year off strong? Let's take a look at the leaderboard and see who's really setting the pace in the world of those federally insured reverse mortgages.
Wow, okay, the big story here is the sheer dominance of that number one spot. Over the past year, Atlantic Avenue Mortgage endorsed 935 home equity conversion mortgages. You probably know them as HECMs. Now, get this, that is more than double their closest competitor. They are just running away with it.
And you can really see that powerful start if you just zero in on January. Atlantic Avenue endorsed 113 loans in that month alone. That's way above their monthly average of around 78. So yeah, they have come out of the gates incredibly strong. But this is where the story gets a little weird.
Right, because despite that incredible performance from the industry leader, the rest of the market, well, it's telling a completely different and honestly a contradictory story. Here comes the plot twist.
And you might not believe this, but from January to February of 2026, the entire HECM market dropped by almost 21%. That is a huge contraction in just a single month.
And this chart just lays it all out, doesn't it? That drop is steep, from over 2,300 loans down to just over 1,800. In fact, this is the lowest level of activity we have seen since the very beginning of the pandemic. So, what in the world is causing this?
To figure out the why, we have to pull back the curtain and look at something called the secondary market. This is where that slowdown is creating a really clear ripple effect. The key here is something called HMBS, mortgage-backed securities, or HMBS. The easiest way to think about these is like packages. You take a bunch of reverse mortgage loans, bundle them together, and then sell those packages to investors. The health of this market is a direct reflection of investor confidence. And in February, well, that investor confidence clearly took a hit. The total value of these securities that were issued, it fell all the way down to $431 million. And this wasn't just some little blip on the radar. We're talking about being down over $100 million from just the month before, and almost $40 million from the same time last year. The takeaway is simple. When investors don't have an appetite for these traditional HECM products, the whole system just slows to a crawl. But you know how it goes. When one part of the market slows down, something else often rushes in to fill the void. And as this federally insured market is hitting the brakes, a powerful new contender is hitting the gas. And if you want to see just how big this shift is, just look at this. By the end of last year, these private or proprietary reverse mortgages already made up a massive 45% of the entire market. They are closing the gap on the traditional HECM loans, and they're doing it fast. So what's the big difference here? Well, HMAHMs, the traditional ones, are federally insured and they have strict government-set lending limits. But these proprietary loans are privately funded. And that means they often have a lot more flexibility, which can mean higher loan amounts. And that's a very attractive option for a lot of homeowners. Okay, so let's bring all this industry talk home. What does this changing market actually mean for the choices available to seniors who want to tap into the equity they've built up in their homes? Well, one of the biggest innovations to come out of this proprietary boom is something called the second-lien reverse mortgage. And this is an absolute game changer, especially for anyone who was smart enough to lock in a super low interest rate a few years back. A product from Finance of America called Home Safe Second is the perfect example. The idea is brilliant. It lets you keep your amazing low-rate primary mortgage, but you still get to access your home's equity through a second, totally separate loan. You get the cash you need without giving up that fantastic rate. And listen, this isn't some tiny niche product anymore. Its availability is growing. Finance of America just expanded it to 3 new states, bringing the total to 16. That signals a really clear trend toward more flexible, homeowner-focused options.
So, as we watch this market completely transform, with the decline in traditional products and this surge in really innovative new ones, it leaves us with a much bigger question. As these financial tools keep evolving, how are homeowners across the country going to redefine what it even means to finance retirement? It's a fascinating shift, and you can bet we'll be watching it closely.